Hey, what's up, stock compounders? Brad here. So it is that time of the week again for our Q&A session. Thank you all for all of you who asked a question this week. I think we had more questions this week than we've ever had in this Q&A series, so that's awesome. Keep them coming. Let's jump right in here. So again, I asked myself a question. I do this every once in a while. I'm not sure why, but I asked, if you cloned Munger and then Pabrai bought in, did Pabrai clone Munger or you? Just being playful there, of course. And not everyone realizes this, but Charlie Munger and Mohnish Pabrai both bought in Q1. So it's not like, Pabrai could have seen Munger's 13F and then decided to buy in. I imagine what happened. I know they meet somewhat frequently. They both live kind of in the greater Los Angeles area. And, Pabrai was talking about a conversation he had had with Munger about cinches, right? And feet up on the desk. A couple of questions that Pabrai added to his investment checklist. And I imagine, Alibaba came up and, once Pabrai found out that Munger was excited about Alibaba or buying into Alibaba, it was an easy decision. I recall, I think it was like 2016 or 2017. Pabrai was, well, I guess what happened is Munger had seen that Pabrai had bought Sears through a 13F or something like that. And, so Munger wanted to talk to Pabrai about that. And right at the beginning of the talk, Munger shook his head. And Pabrai, he said, when God, which he sometimes refers to Charlie Munger as God, does this, right after that meeting, immediately you go and you liquidate that position. So, I know Pabrai has just a ton of respect for Charlie Munger. And I think a big part of that position was a shameless clone. Obviously, Pabrai has talked a little bit about Alibaba recently with his spawner framework. He recommended to buy Alibaba in the the free lunch portfolio. So he's had some exposure to it. But anyway, that's my thoughts there. Are you buying more shares in Alibaba now that the price has gone down? It's a little painful watching the price go down, but I got to remind myself, I'm in this for the long haul with Alibaba, 10, 20 years. It's not going to matter too much, if I save 10% here or there on my purchase price. I actually made a full position in Alibaba back in April of 2021. 20%, okay, of my investment portfolio is in Alibaba. So I'm not going to buy more. Even it can go down a lot more, and I'm still not going to buy more because, I have a full position, and we're just going to leave it there. Is there a routine you follow when quarterly results come out for your companies? For example, read them, write their numbers down, and see how they compare with guidance / your expectations. Also, maybe for the annual report, try to figure out whether the moat has widened, etc. Curious about this because I've been thinking about making a folder for each company where I write down what happens every year in terms of business and every quarter in terms of numbers. So I don't have a very well-defined process for this. I like to read quarterly results as they come out. I don't always get to them right away. Most of my investments are kind of multi-year plays at this point. So, I'm not eager. I'm not in a hurry to read the information as it comes out in real time. But, I like to keep up with them for the most part. I think probably most people who are long-term investors spend too much time. Value investors who own businesses spend too much time combing through the minutia. Okay, I forget who I heard it from recently. I think it was Bill Miller. Bill Miller used to run these fairly complicated discounted cash flow valuations for companies, and eventually he realized, there's really only a couple metrics that are going to move the needle for this company over time. So it just radically simplified the process that he uses to keep up with how companies are evolving in his portfolio. What did those couple metrics do each quarter, each 6 months, each year? So I would really encourage you guys to simplify that process as much as possible. Jake, Pabrai has recently talked about how he is looking for 50x to 100x positions, but recently bought Baba. What do you make of this? Is he fully following his mentor and buying phenomenal businesses at good prices, or is this a cash alternative given recent market movements? No problem for the Berkshire Hathaway meeting multiple questions in one. So what do I make of it? It's hard. I can't see Alibaba as a 50x, 100x over time, really, just because of how large it is now. But, I think it could be a 10x in the next 10 years. I don't think that's too unreasonable. And, that comes both from the margin of safety that's paid today, kind of the discount where the price is versus the value of the business, and the spawning DNA nature of Alibaba, right? If it's kind of spinning out these businesses within the Alibaba umbrella, that can add value as well. So yeah, I think a big part of it is, he knows it's a spawner. Yes, it's much bigger than the companies that he's targeting, which are like $500 million or smaller in market cap. But if it's a cinch, if it's a cinch 10x in 10 years, I don't know exactly what his target is in terms of returns over the next decade or 2 decades. But, like I said, Charlie Munger, that's the guy sitting behind him in his office. The statue, the bust is Charlie Munger. So, when God says, hey, I'm going fairly big on Alibaba in, Daily Journal, it's probably not too difficult of a decision for Pabrai to carve out 1 out of 10 slots in Pabrai funds to make room for a business like that. So I do not think it's a cash alternative. Pabrai doesn't invest in cash alternatives. He has a very high bar for what companies need to be able to do over the next 5 to 10 years. And so I presume Baba met that hurdle. So he doesn't, as far as I know, do cash alternatives. Frank, Mohnish said he is looking for long-term compounders with a never-sell mindset. With a company as large as Alibaba that will require a lot of reinvestment for growth, runway is limited due to scale and margins might thin from competition. Is this really a long-term compounder? For 5 or maybe 10 years, I get it, but more than 10 years seems hard to justify. Thoughts? Well, one consideration there is the growth projections of China, right? In terms of, income per capita. There are so many tailwinds in that market. It wasn't that long ago. Li Lu talked about this in his recent talk at Columbia, how, China was all about exports, right? That was the bulk of their economy. And I think it was only maybe 10 years ago or so, if I'm remembering Li Lu's talk correctly, that it kind of shifted. It's shifting into a more consumer-driven economy, okay? So, considering the population of China versus the U.S., when you've got a whole populace, right, in a country as big as China, where, that shift is taking place, that's a huge tailwind. So, I think that's probably a fairly large part of the thesis. So yeah, 5-10 years, it might be longer, quite frankly. It might be longer. especially with the spawner DNA of a company like Alibaba. If it can continue kind of kicking off businesses from that umbrella, who knows how large it can get. So that's too hard for me to answer. I just know I really like the upside to downside picture right now with Alibaba. As far as how long-term of a compounder it's going to be, I can't say. I just read Dondo Investor, awesome book. A lot of the books seem to be about looking for discounted pies. That is absolutely true. If Pabrai could rewrite the book, do you think it would be a lot different, considering he has changed his investing mindset? Yeah, he mentioned this. When was it? It was, I can't remember which talk he was giving. It was at some business school, I think. How, the framework does change, where, initially he was really focused on the downside, okay? How do I not lose money? And then the upside will kind of take care of itself. It's a little different if you're looking for long-term compounders, okay? Pabrai said you can't really buy a dollar for 20 cents and have the long-term compounder situation, okay? It's very hard to check both of those boxes in one investment. I mean, he says he did that with Racist, right, out of Turkey. But, God isn't going to give him many opportunities like that. So I do think he would have kind of a different framework if he were writing the Dondo Investor again. But I don't think he's going to do that in the next couple of years. I think he's probably going to need to get some investments under his belt that fit this 100-bagger framework before he's going to be comfortable really writing a book about it. So I think there will definitely be differences. I hope to see that book in 5 or 10 years from now. I think that would be a fascinating read. Dwight, is there a specific site you use for researching management CEO history? Macro Trends used to be it for me, as it was made really simple and fairly thorough, but it seems like this feature was removed recently. Yeah, there isn't one source that I use for that. I like Scuttlebutt, which is, just kind of looking at LinkedIn, Google search. What can you tell me about this person? Search maybe the CEO, the CFO, some high level management individuals, and try to figure out, what has their history been. But I don't have a specific site that I use. It'd be great if I had something like that. It would really make that process quite a bit easier. But I haven't found anything like that. John, I've heard a thought that when you invest a small amount of money, it's imperative to look for value stocks, to buy a dollar for 50 cents. But when you increase your portfolio, then you can switch to growth stocks like spawners. What are your thoughts on that? Yeah, it does seem like that's the trajectory that a lot of great value investors have taken. I don't know that it's necessarily a better idea with a small amount of money to buy dollar bills for 50 cents, to buy discounted pies. And when you get a larger amount of money, because of that, it makes more sense to buy growing pies, right? The spawners, the long-term compounders. It's an interesting question. I haven't thought too much about it. Even if you have small amounts of money, you're still going to get the tax hits of the buying and selling a dollar for 50 cents every couple of years. So, yeah, and it's obviously less work if you can identify the long-term compounders, which isn't necessarily a huge deal for someone who's managing a small amount of money if they have the ambition to put in that work to be buying in and out of companies every couple of years. My sense is that it doesn't matter so much. I think even if you're managing a small amount of money, at least that's where I'm coming from. I'm not managing huge sums of money in my portfolio. I'm still wanting to make this switch to long-term compounders. And I can't really back it up with numbers at the moment. But I like the game. Feels more exciting to me, quite frankly. The game of trying to identify these long-term compounders versus the game of buying $1 for 50 cents every couple of years. So, and part of that is just this knowing that I want to cultivate that patience when I buy into a company. I know that's such a huge advantage for investors over the long term, is to have the patience, right? The patience to let the compound growth engine just really just hit that hockey stick growth curve. So those are some kind of rambling thoughts on that question, but I'll probably think more about that going forward. Bill, a year ago you sold Graphtec. Yes, I did. I lost like $8,000 on that. A year later has done quite well. I don't know where it is. I'm not even going to look. Do you think Pabrai would have sold within his new framework? I don't think he would have bought in the first place. I think he really saw Graphtec as a discounted pie. So, yeah, I don't think it would have fit his spawner framework. I mean, it's kind of a commodity business. I don't think it would have been compelling from a 10 to 100x kind of, projection going forward. So that's my take on Graphtec. What is the maximum number of companies you have ever owned? I find it very difficult to consistently track more than, say, 5 companies. Well, so I have kind of my value investor stock picking portfolio, but I also have a kind of test portfolio from Magic Formula. And with that one, I'm buying 20 companies a year. I'm probably going to hold them for 2 years or more. But that's different because I'm not actively keeping track of those companies. This is really, I have filters that I use for Magic Formula, and it's all quantitative. Okay, it's very mechanical in terms of its approach. But in terms of companies, that I pick individually, I think it's probably been like 8 or something like that. I haven't invested for a huge amount of time. I think I started like 5 years ago. So probably 8 would be the most I've ever owned at once in that sort of concentrated stock portfolio. But yeah, I mean, if you find it difficult to track, I said this earlier in this video, maybe you're tracking too much, right? Maybe you're getting too much into the weeds, and it might be helpful to pull back a little bit and look at just those couple metrics that really matter over time. But yeah, if you don't want to track more than 5 companies, I don't think you need to own more than 5 companies for diversification or anything like that. I think it's absolutely fine to have 3 to 5 companies in your portfolio and watch those very closely, provided you understand them very well and you have some insights about what's going to happen in those industries over the next decade. I have no issue with just owning 5 companies in a portfolio. Time to look at Shinken. I believe they released some financial news. I had to admit, I just start a good position in Baba because of you. All right. Cloning the cloner. Where is Lilu's most recent 13F? I think we're going to see Lilu's 13F on Monday. Okay. So keep an eye out for that one. I am very excited to see that. Hopefully he's done something. Shinken, I haven't looked at Shinken in a while. I only put in that initial buy that I made a video about a few months ago. I'm not sold on shifting everything over to Interactive Brokers. So I haven't bought any more Shinken, and I've just had a lot of other stuff to look at, so I haven't seen updates from them. What is your process of cloning? Once you find a new business in the portfolio of a super investor, what are the next few action items on the checklist before buying the business? Well, so it's got to be a company in an industry that is interesting to me, okay, and that I think I might be able to understand the business. So that's a big starting point. I like to see a high insider ownership. What else? It's got to be interesting, and it's got to be a company that I want to follow over the next 5 to 10 years, right? It's got to be a company that I can kind of get behind. Like, okay, I want this company to be successful. So those are some things I look at when I'm looking at what great investors bought in the last quarter. Yeah. After dinner investor, Mohnish sold some of his Micron stake. What do you think about this? Are you selling? Yeah, what was that? I'm just going to take a quick peek at how much of that Pabrai sold. So about 15% Pabrai trimmed Micron. I mean, Pabrai says himself, there's 100 reasons that someone would sell a stock. There's really only one reason that they buy. They're bullish on the investment in that company. So 15% doesn't really faze me. Certainly, it's not necessarily like a bullish indication at current prices that Pabrai is excited about Micron. But no, it hasn't. I saw it and I didn't even really think twice about it. I'm not going to trim my Micron position. But Pabrai has even said he's watching Micron fairly closely. It's not one of these long-term compounders. So he is going to get out probably sometime in the next couple of years. But 15% isn't enough for Pabrai for me to feel compelled to do anything with that position. How do you think about your cash position and keeping some on the sidelines? Well, yeah, the nice thing about me being in kind of the earning part of my life, right? I'm not retired. Money is coming in, so I don't feel much of a need to have a cash position. Cash is constantly coming into the portfolio as I earn it. So really, the cash piles up if I'm not able to find any compelling investment opportunities, and I don't feel pressured to put cash to work in any sort of time frame. I think Buffett feels the same way about that largely. So I don't intentionally try to keep it on the sidelines. I don't. It's really, do I have compelling opportunities to do something with that cash? And if I don't, I do not want to force any opportunities, right? I'm waiting for these fat pitches. So if nothing's coming, the cash piles up. If I find something, I'm happy to put all that cash into it. So that's kind of how I think about cash. Prem Watsa from Fairfax Financial added into his biggest position, Atlas Corp. What are your thoughts? I just want to see how much that changed with Prem. I mean, he added 0.17%, so I don't really consider that any kind of an addition to Atco, to Atlas Corp. And it's not really a company I've looked into. It's in the, I think it's in shipping or something like that. It's not kind of in my wheelhouse. It's not even really an industry that I'm interested in. So I don't have any thoughts on Atlas Corp. Thank you for your great content, Joel. You bet. Do you use any other resources for tracking the super investors beyond Dataroma? Yes, I use Ticker Terminal. Okay, so the nice thing about Ticker Terminal is, of course, whenever I open Ticker, the things are always behind my feed there, which is always a little fun. So track investing gurus is a pretty useful function in Ticker Terminal. Okay, so with Pabrai, we can look at his 13F, and there's 3 positions there, but we only get to see companies he bought through U.S. exchanges. Okay, Micron, Seritage, and Alibaba. You can see 13F. That's where we can see those. For these other companies that are outside the U.S., the easiest way that I know of to find those in one place is through Ticker Terminal. Okay, Ticker Terminal is in beta. It doesn't charge anything. You have to be invited. I'm happy to send you guys an invite. I'm not making anything on the invite. I may get a kickback once Ticker moves out of beta and decides to charge, a monthly fee or an annual fee, whatever they decide to do. But I'm not counting on anything like that. So this is how I track investors, what they're buying outside of the U.S. But that's really it. Well, that's not true. Whale Wisdom is another place I use, because there are super investors like Ray Dalio. There's a fund out of London that I also track that aren't in Dataroma. Okay, so there's only 70 some, I think, super investors that are tracked in Dataroma. So there's so many more great investors to look at. So Whale Wisdom is a source I use for those. So those are a few, but I'm sure there are so many more. I know at one point, Rule 1, why am I spacing? Why am I spacing on his name? That's terrible. Phil Town. He's got a paid website where you can track gurus within kind of that paid service. So that's another option. I've never used that one, but it's probably good. Yep, there you go, Joel. Just getting started. What do you think would happen if all speculators and day traders left the stock market for crypto exchanges? Is there any reason for them to stay, considering they don't really focus on the business aspect anyway? Well, one reason I think they stay, it's a big shift to go from day trading and speculating on equities to learning how to do that with cryptocurrencies. Okay, I'm sure there's some things that carry over, but I don't know anything about day trading and all that stuff, speculating. But I'm sure there's a learning curve switching over. But what would happen? Well, there'd probably be less volatility in the stock market that these day traders are most active in. Probably be less of a bubble, less of a violent run up in the stock market. I don't really know. There's always going to be speculators. It's just the cycle of markets. It's really interesting. So if you think about where we are in the market cycle, we don't know until we have a downturn and we can look back and say, okay, that was the market cycle. But at the bottom, right after a crash, there aren't really speculators that are involved in the market. It's the diehards, right? It's the long-term value investors are the only ones who are willing to go in, because everyone else has been scared out, right? They think, this stock market thing, it's a scam, right? Look at what just happened, and everyone's terrified. Everyone thinks the risk is highest right after a crash, even though the risk is actually lowest, because that's when prices are lowest. And price to value is really the equation for determining risk. So at the bottom, after a crash, you don't have speculators. And as the market goes up and up over time, that's when the speculators, the day traders, come in. Okay? and that's when activity from them is highest when we're in this bubble kind of territory, which it kind of feels like we are now. I don't know that, and I don't make investment decisions based on that. That's kind of a macro, topic that I don't give much weight to. But it's just part of the cycle. We're in this. Feels like we're in the frothy end of the cycle where there's just all of this speculation and day trading activity, but it'll go away. When the next big downturn happens, you're not going to see that. So, it's interesting to think about cycles. And Howard Marks. Howard Marks is my favorite investor to read in terms of how he thinks about market cycles and things like this. Let's see. You talk a lot about insider ownership for the CEO. How come some of your positions, Micron, don't have high insider ownership, or does it only matter for certain stocks or positions? So insider ownership is a fairly recent filter that I've started using. I really picked it up from Chris Meyer, author of 100 Baggers. So I didn't have that framework when I bought Micron. Okay, so that's the answer to that. I'm guessing moving forward, the vast majority of my new buys, my new investments, are going to have at least a 10% insider ownership. That's something that is becoming more and more important to me over time as I expand my investment education. Wondering why you are not into net stocks, or would you consider this if you would find some? Buffett had his biggest returns mostly from this. I'd like to see some data on that. My sense is that Buffett's biggest returns were not from nets. I mean, I think Charlie Munger mentioned this about Benjamin Graham. Benjamin Graham was big in nets, but Benjamin Graham's best performing stock was Geico. Okay, that's where Graham made the vast majority of his money. And Geico was not a net, all right? So part of it is, I think it's a lot harder to find nets today with the tools that every investor has access to for quickly screening stocks according to, metrics like that. I'm sure there are some in, emerging markets, things like that. There's probably even some in the U.S. But, again, my framework now is this long-term compounder thing, right? I don't want to have to constantly determine where I'm going to allocate my money. I want to give it to great businesses, great management teams, and let them compound it for me, okay? I'd vastly prefer that. So that's the framework I'm using. I don't even think I'd look. I don't even think I'd be interested if I found a compelling net, unless, for whatever reason, it had kind of long-term compounder DNA. Then I'm definitely interested. Tom, I found you through a search for Magic Formula Investment Method. Awesome. Yeah, a lot of people find me that way. I was wondering if you have a method to track your own investments, some sort of report on each holding. And when you have that, what do you write down there? I have already started an inventory of my holdings a number of times, but I am unable to arrive at an unambiguous working method. Do you have any tips? I don't really have any tips on this. So I have so few stock positions. I have like 3 significant holdings right now. So because of that, it's fairly easy. I don't need this complicated process to track my investments and updates on each one. So, that's that's one solution, is to really get concentrated in your portfolio. Of course, you have to be comfortable with that. Not everyone is. But yeah, I don't have any particular insights about this one. Yeah, I'm sure other investors do. Shane, are there any ethical concerns about investing in Alibaba or Chinese companies in general? Yeah, we each have our own kind of ethical framework, right? What's right and wrong? What do we want to stand for? What do we want to stand against in the world? So I would encourage all of you investors out there to really understand the businesses you're investing in, the issues, the supply chain situation, how people are treated, employees, everything that's affected by the business. I think the world would be a better place if investors really took a thoughtful approach to the kinds of businesses that we want to be owning and voting for with our money. I haven't found any particular ethical concerns with Alibaba specifically. And I don't know the Chinese market super well. So I'm learning. I'm sure I'm going to learn as I go along about what I want to put my money behind, what I don't want to put my money behind. But yeah, I think it's important. I think people, well, for me personally, I want to feel comfortable. I want to feel good about owning the businesses that I'm investing in. Okay. So that's my take on that, Shane. Thanks for that question. Last one. How do you know that a company is a value trap? Yeah, one way that I kind of came across recently. If you go to Value Investors Club, okay, probably most of you are familiar with it. It's a website built by Joel Greenblatt and his team where investors submit investment ideas. It has to go through a panel, and they say, okay, this is good enough to make it into the club where other people can read it, or no, this one doesn't make the cut. One thing you can look at in Value Investors Club, how many years going back have investors been bullish on this company, right? So if there's a write-up like every couple of years for the last 10 years or 20 years, potentially a value trap, right? Magic formula. If you're able to look back, I'm sure there's a way you can do this. I think there's a website that every day tracks what shows up on the magic formula. If you look back and this company has showed up on the magic formula for years, right? Could be a value trap. So, those are some clues that it could be a value trap. But yeah, I mean, it's really just understanding the business. How confident are you in your, projections out into the future that, this is going to be a better business in a decade or two than it is today? So just a few thoughts on that. You never really know if it's going to be a value trap, but it's a good question to ask yourself. I think it's a good question to have on your investment checklist questionnaire. Could this be a value trap, right? Maybe some sub-questions underneath that, because that's no fun, right? We're holding companies for 3, 5, 10 years. When you do that with a value trap, it's painful, okay? Because the opportunity cost is just massive to have that capital locked up for all of that time with a company that's just not doing anything. So that's my take on that one. All right, guys, that is all of the questions for today. Thank you for everyone who asked a question here at the weekly Stock Compounder Q&A. And again, I'm excited to dive into these 13 Fs on Monday. Most of the investors on the list of gurus that I track have not yet released 13 Fs. So keep an eye out for that video. All right, guys. Keep compounding, and I will see you all in the next one. Take care.